In what other scenario do we hand a $100,000 contract to someone who can't legally buy a beer? Think about it. You can't rent a car at 18. You can't get a hotel room in most states, but you can absolutely sign away the next 20 years of your income before you've ever paid a bill in your life. And here's the wild part. Nobody sits you down and explains what you're actually agreeing to. You fill out a form, click some boxes, and suddenly you owe more money than your parents paid for their first house. I'm not here to tell you college is a scam or that student loans are evil. That's not how this works. What I am here to do is explain exactly what's happening when you sign those papers. Because when I finally understood this stuff years after graduation, I was genuinely annoyed that no one had broken it down for me earlier. So let's fix that. First, let's talk about what student loans actually are. At their core, they're just borrowed money. You take someone else's money now and you promise to pay it back later with a little extra on top. That extra is called interest, and it's how lenders make their profit. But student loans have some quirks that make them different from other kinds of debt. The biggest one? They're almost impossible to get rid of. If you buy a house and can't pay for it, the bank takes the house. If you buy a car and can't pay for it, they repossess the car. But your degree? Nobody can repossess your bachelor's in psychology. So instead, student loans follow you. Even if you declare bankruptcy and lose everything else, your student loans typically survive. They're like that one friend who shows up uninvited and never leaves. This is why lenders are so willing to give massive amounts of money to teenagers with no income, no credit history, and no collateral. The debt sticks forever. Now let's talk about how interest actually works on these loans, because this is where the trap really snaps shut. When you borrow money for college, interest usually starts accumulating right away. But here's what trips people up. While you're in school, you're often not required to make payments. Sounds like a relief, right? The problem is that interest doesn't just pause and wait politely for you to graduate. It keeps growing. Let me make this concrete. Say you take out $10,000 your freshman year at a 6% interest rate. By the time you graduate 4 years later, you don't owe $10,000 anymore. You owe closer to $12,600, and you haven't spent a single extra dollar. That's just the interest that piled up while you were studying. Now multiply that by each year of borrowing. Many students take out new loans every semester. Each chunk starts its own interest clock. By graduation, you might have borrowed $40,000 total, but you actually owe $50,000 or more. This is called capitalization. It's when unpaid interest gets added to your main balance, and then you start paying interest on that interest. It's like a snowball rolling downhill, except the snowball is made of your future money. Here's where it gets even more complicated. There are two main types of federal student loans, and they work differently. Subsidized loans are the better deal. The government pays your interest while you're in school. So if you borrow $10,000, you still owe $10,000 when you graduate. These are based on financial need, and there are limits to how much you can get. Unsubsidized loans don't have that benefit. Interest starts day one and keeps compounding. Most students end up with a mix of both, but there's a cap on the subsidized amount, so the bigger your total borrowing, the more unsubsidized debt you're taking on. And then there are private loans. These come from banks and other lenders, not the government. They often have higher interest rates, fewer protections, and less flexible repayment options. If federal loans are like a stern but fair relative, private loans are like borrowing from that friend who never forgets you owe them. Now let's talk about repayment, because this is where people's eyes really start to glaze over, which means this is exactly where you need to pay attention. When you graduate, you typically get a 6-month grace period before payments start. Sounds generous. But remember, on unsubsidized and private loans, interest is still accumulating during that time. Your balance is growing before you've made a single payment. Once repayment kicks in, you have options. The standard plan spreads your payments over 10 years. Sounds manageable until you do the math. Let's say you graduated with $35,000 in debt at a 5% interest rate. Your monthly payment on the standard 10-year plan would be around $371. Over 10 years, you'd pay back a total of about $44,500. That's almost $9,500 just in interest. But wait, Many people can't afford $371 a month right out of college, so they switch to income-driven repayment plans. These cap your monthly payment at a percentage of your income, which sounds great. Lower payments, more breathing room. Here's the catch. Lower payments mean you're paying off the principal more slowly. Sometimes you're not even covering the full interest each month, which means your balance can actually grow even while you're making payments. You can pay for years and owe more than when you started. Income-driven plans stretch your repayment to 20 or 25 years. At the end, any remaining balance might be forgiven. But there's a twist. That forgiven amount can be counted as taxable income. So you could end up owing the IRS a chunk of money on debt that got forgiven. I told you this gets complicated. Now, let's address the elephant in the room. Why do we let 18-year-olds sign up for all this? Part of it is that we've collectively decided higher education is so valuable that access to it should be easy. And for many careers, that's true. A doctor, an engineer, a teacher, all of them need degrees to do their jobs. But here's what often gets lost in the excitement of college acceptance letters. Not all degrees lead to salaries that can comfortably handle the debt. If you borrow $80,000 to get a degree in a field where the average starting salary is $35,000, you're going to struggle. That's not a judgment on your choice of study. It's just math, and nobody makes you do that math before you sign. Nobody sits you down with a calculator and says, "Okay, you want to be a social worker. That's wonderful. Here's what your monthly payments will look like on your expected salary. Can you afford rent, food, and this payment? Let's see." That conversation almost never happens. Instead, you get vague reassurances that it'll all work out and that your degree will pay for itself. Sometimes it does, often it doesn't. So, what do you actually do with this information? If you're about to take out loans, slow down and run the numbers. Look up the average starting salary for your intended career. Use an online loan calculator to figure out what your monthly payments would be. Compare that to what your take-home pay would actually look like. Not your salary, but what's left after taxes. If the monthly payment is more than 10 to 15% of your monthly take-home, you might be borrowing too much. Consider starting at community college for your first 2 years. Those credits usually transfer, and you can cut your total borrowing significantly. There's no shame in this. It's just smart planning. If you already have loans, look into income-driven repayment if your payments feel unmanageable. Yes, you'll pay more interest over time, but you won't default. Defaulting wrecks your credit, leads to wage garnishment, and makes everything worse. Look into public service loan forgiveness if you work for a government agency or nonprofit. After 10 years of qualifying payments, your remaining federal loans can be forgiven tax-free. But you have to be on the right repayment plan and submit paperwork every year. It's not automatic. And if you're a parent helping your kid navigate this, please sit down with them and do the math together. Make sure they understand what they're signing. Because when I was 18, I thought 10 years was basically forever, and that future me would figure it out. Future me was not thrilled with that plan. Student loans aren't inherently bad. They've helped millions of people access education they couldn't otherwise afford. But they're a tool, and like any tool, they can build something great or cause serious damage depending on how they're used. The system doesn't explain itself well. It counts on you being too overwhelmed or too excited to ask hard questions. So ask them anyway. Because understanding this stuff isn't about being a finance expert. It's about making sure that when you sign your name on a $100,000 contract, you actually know what it says. If this breakdown helped something finally click, consider subscribing to Like Your 5. We take complicated money topics and explain them like a friend would. No jargon, no judgment, just clarity. Because you deserve to understand what you're signing up for.